Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The private credit market has seen rapid growth in recent years. According to the IMF, last year the market topped $2.1 trillion US dollars. That's about 3 trillion Aussie dollars globally in assets and committed capital. But what do deals in this space actually look like? And how does a private credit provider assess risk? All important. How does it preserve investor capital? Remember, this is general information only, and you should seek professional advice before making investment decisions. Paul Miliotis is the co-founder and managing director of Msquared Capital, a great supporter of this podcast. Paul, welcome to Fear and Greed.
Thank you, Sean.
Okay, first off the bat, tell me about Msquared Capital, Paul. What do you do?
So, Sean, Msquared Capital is a private credit provider. So what we do is we qualify borrowing opportunities. So a borrower will come to us for financing, and then we'll match that borrowing opportunity with one of our 3 investment offerings, depending on the risk of the asset or of the borrowing.
Okay, so there's 2 sides to this. So let's talk about the borrower first, and we'll talk about the funder next. The borrower, typically, who is it coming asking for money?
So for us, there's different parts of the risk profile of private credit. So where we sit in the sphere of private credit is secured debt. So what that means in the secured debt space is all of our borrowers must provide real estate security for us to take. Mm-hmm. And where we sit is right in the middle of the risk profile. So we're really looking for the borrowers are just falling out of where the banks are looking to lend for a number of reasons. They may come to us and not up the risk curve. So we don't like borrowers that are what we say are a falling knife. There are a lot of problems around them. We just want them to be just outside of what the banks are looking to do.
Okay, now we know that the banks have tightened criteria on lending over the past couple of years, and part of that is COVID related plus other things. Is that part of the reason why so many more people are looking for private credit?
I think there's 2 sides to that question. I mean, the banks, when the banks want to write business, they'll write business. But at the moment, what we're finding are people are coming to us for a number of reasons. Number one is speed. So at the moment, the banks are slow when there's something that is a little bit complex. So speed is one major aspect why private credit is really popular at the moment. We can turn over a debt transaction in 3 to 5 days. The other major reason from the borrowing perspective, and you mentioned it, COVID or otherwise, banks look at historical aspects of a borrower's situation. So they might want your tax returns for 2 years. So it's a historical looking at a business. When we're versed in private debt, we can look at from a period of time of that particular borrower, which is now. So when our business doubled at COVID and just after COVID, and the reason was exactly that, the banks would look at how they traded during COVID and couldn't really see outside of that. Yeah. Businesses were categorically smashed during COVID. So things changed pretty quickly when they got out of it. So when we were able to see where they were at the period of time, we really could assess that risk as manageable and lend money to those particular borrowers.
Okay. And then just finally on the borrowers, how much are they borrowing from you typically?
Borrowers typically borrow 65% of an asset value from us. So if we've got an asset, let's say round numbers for my mathematics is a $10 million house. Now, obviously $10 million houses we don't see every day. We would lend them $6.5 million against that particular asset value at the top end. So for us and our investors, it's very important to limit how much we are lending against that asset. So in that particular instance, for our investors to lose money, that property price would have to drop 35%. And where we are typically lending in the eastern seaboard of Australia and existing residences, we deem that risk definitely appropriate.
Stay with me, Paul. We'll be back in a minute. My guest this morning is Paul Miliotis, co-founder and managing director of Msquared Capital. So let's flip to the funding side. You said there are 3 funds. These are private investors putting money into Msquared. Is that how it works?
We get flows of capital from a number of sources. So when we started the business, we figured out pretty quickly that no investor is the same. And different investors want different risk profiles and different things. So we've got 3 different funds. The first fund we have is a single asset fund. So that single asset fund, people will lend into a specific investment. It is quarantined for that particular investment, and you can pick and choose whether you want to participate in that borrowing opportunity. A lot of our investors like that style investment, but a lot of people wanted to be secured over a range of assets. So we've got two other investment vehicles, which are pooled funds or open-ended funds, where there's investment over a number of assets. And we've got two different funds. The first one is the Mortgage Income Fund, which is on the lower risk side of lending. So in that particular fund, it's currently at a 55% geared transaction. But importantly, it's what's in that fund that we do that is important to understand. We will not do any second mortgages in that fund. So first mortgages only. We will not lend land at all, no construction, and we won't even lend in against any regional property in that particular fund. And that's returning 8% net to our investors paid monthly. The third investment vehicle that we have is the high yield fund, and that goes up the risk curve slightly. We've got up to 20%. Currently, we've got second mortgages. We've got 2% of that particular fund in construction, and we're tapping that out, and a small amount of land at about 12%. And that's allowed us to get a return to our investors last month of 10.35% per annum, paid monthly again.
Okay, so they're the two sides to it. I presume the structure of the deal, I mean, I don't want to get into the nuts and bolts of the structure of a deal, but broadly, it's sort of similar as going to a bank in terms of security against the property. How do you, as an organisation, Msquared Capital, how do you do your due diligence? Because I'm sure it's more than just saying, hey, what's your house worth?
It is. Like, collateral is a very important aspect of it. So let's make no mistake that in the unlikely event you've got to recover your money, you do have to sell that property. But that's only one aspect. Over the years, we have curated a process. Now, we've returned 100% of investor capital and interest for our entirety of our fund, and there's a good reason for that. The due diligence process first starts with governance. So we've got a credit committee with 2 executive and 2 non-executive signatories on that credit committee. And unless that's a unanimous support of all 4 members of that committee, the investors will not see that deal. It'll be declined from an M-squared perspective. So governance is the first thing that is extremely important. Mm-hmm. The second part is, collateral we've talked about, but there's other aspects that we look at private credit. The number one aspect that we have is, how are you going to get the debt repaid? How are our investors going to get their money back? And there must be a defined exit to that. But competence. Does the particular borrower have the competence of what they're saying they're going to do? Do they have the cash flow to actually make our interest payments so our investors get paid monthly? Do they have the character, which is an extremely important part? The due diligence of what we do is centric on character. How's their credit score? Have they defaulted on any mortgages before? If we're refinancing something, have they missed any payments? Is there a reason why they missed payments? Those are the type of things. So unless they hit all those 5 aspects that we've mentioned, the character, the capacity to repay, the cash flow to make our repayments, the competence and the collateral being acceptable security for us, then we won't do the deal.
Okay, so every investment is, and I'm thinking from a funding side here, there's a risk to it. And the key risk is that the borrower doesn't repay, and I suppose where the opportunities are. So, in a nutshell, the risks and opportunities of going with Msquared Capital on either side of the deal in terms of accessing private credit or in terms of providing funds for private credit.
Yeah, look, the risks in private credit are great. Different funds do different things. And I'll give you an example, Sean. We won't do any property in our business that has a valuation that's based on going concern value. For example, a pub. Now, I'm not saying that if you lend to a pub, you're going to do your dough. But what I'm saying is, for the investors to understand the risks of investing in that particular asset class, you really need to understand it. So when we're deeming the risks of the economy being greater now, you've got headwinds on interest rates and capacity to repay in their own capacities. We find that the turnover of the pubs will invariably go down. So in that instance, the valuations must go down. So when you're looking at risk of lending, you need to understand what's under the bonnet and make your own assessment as an investor, whether that's appropriate. Now, when COVID came in, I'll give you another example. There was a huge influx of people wanting debt in regional areas, holiday houses and the like. Now, we have an issue with regional areas, not because we don't like holidaying there, but when things turn pear-shaped in an economy, what we have found in our history is that the first thing that goes are regional properties. People will sell them before they sell their houses. And when there's a a number of properties on the market at the moment. What happens to those values? They go down. So if you look in Melbourne, for example, in the areas which are great to live in and holiday in, your Sorrentos, your Mornington Peninsulas, what we're finding now is a lot of people are offloading those properties. There's a lot more on the market, and there's a lot more time on the market to get those properties away. So if investors, for argument's sake, are on a fund that these people need to get rid of those assets or they can't pay their interest, and people are living off that interest they're receiving from private credit, that could be an issue and a risk for them. So the risks on what's under the bonnet for investors, I think, and understanding what's under that bonnet is very important. But there are also huge opportunities in our space. We've had an influx of capital coming from self-managed super funds, for argument's sake, where they would be holding cash in their self-managed super. They understand the risks of private credit. They wanted to increase their return that they were getting, and part of their allocations have been to private credit because private credit are paid monthly. They understand the risk of what's under the bonnet being the security of property, and that's worked really well.
And at the end of the day, your returns have been pretty good.
Well, yeah, if you're getting term deposits of your 4 and 4.5, if you can get away with them, depending on how much you're putting in, and we're returning on the lowest risk of our funds, 8% net paid monthly, which is important, we have had a good flow from that part of the market.
Paul, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Paul Miliotis, co-founder and managing director of Msquared Capital, a great supporter of this podcast. This is Fear and Greed Business Interview. Remember, this is general information only. You should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.